Quantitative easing is one of the most powerful monetary policy tools used by central banks around the world. It's a strategy employed when economies face severe downturns and traditional methods are no longer effective. In this video, you'll learn how central banks literally create money out of thin air and use it to purchase financial assets, thereby injecting liquidity into the economy. This unconventional approach has been used during major economic crises to prevent recession and stimulate growth. Quantitative easing, often abbreviated as QE, is a monetary policy tool where central banks purchase financial assets to inject money directly into the economy. Think of it as the central bank using its ability to create money to buy things like government bonds and other securities. This becomes necessary when traditional interest rate cuts are no longer effective, particularly when rates are already near zero. At that point, central banks need a different approach to stimulate economic activity, and that's where quantitative easing comes in. The process of quantitative easing happens in three main steps. First, the central bank creates new money electronically, essentially adding digital currency to its balance sheet. Second, it uses this newly created money to purchase financial assets from banks and other financial institutions. Third, this money flows into the financial system, giving banks more liquidity to lend to businesses and consumers. It's important to note that no physical money is printed. This is all done electronically through the banking system. Central banks can purchase various types of assets during quantitative easing programs. Government bonds, which are treasury securities, and government debt are the most common. Corporate bonds, which are debt instruments issued by private companies, are also purchased. Mortgage-backed securities, which are assets backed by housing loans, help support the real estate market. Finally, other securities and various financial instruments may be purchased depending on the economic situation. The type of assets purchased depends on what the central bank wants to achieve and which sectors need support. Quantitative easing has three primary goals. The first is to lower long-term interest rates, making it cheaper for businesses and individuals to borrow money for investments and purchases. The second goal is to increase the money supply and liquidity in financial markets, ensuring banks have enough funds to lend. The third goal is to stimulate overall economic growth and investment by making capital more available and encouraging spending. When these goals are achieved, the economy should start recovering from recession or stagnation. Quantitative easing produces several notable economic effects. First, it provides easier credit access because banks have more funds available to lend to businesses and consumers. Second, it typically causes asset price increases as demand for stocks and bonds rises due to the increased money supply. Third, it often leads to currency depreciation because the increased money supply can reduce the value of the currency relative to others. Finally, it acts as an inflation stimulus, helping to prevent deflation and encouraging consumer demand through increased purchasing power. Despite its benefits, quantitative easing comes with significant risks. The most serious concern is the risk of excessive inflation if the policy is not managed carefully. When too much money floods the system, prices can rise rapidly. Another risk is the creation of asset bubbles, where stock prices, real estate values, or other assets become artificially inflated beyond their true value. Finally, there's the issue of wealth inequality, as those who own assets like stocks and real estate benefit far more from rising prices than those who don't, potentially widening the gap between rich and poor. To summarize, quantitative easing is a powerful tool for economic stimulus that central banks use when traditional methods like interest rate cuts are no longer effective. Central banks inject liquidity into the economy by purchasing financial assets using newly created money. The main aims are to lower interest rates and increase the overall money supply in the economy. However, this powerful tool must be carefully managed to balance the need for economic growth with the risk of runaway inflation. Understanding quantitative easing helps you grasp how modern central banks respond to economic crises and work to maintain economic stability.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.